My name is Alex Wilson, and I put together this 2026 preview for the Toronto real estate market. On top of the preview, I will be going over what I see for the first half of this year, for the second half of this year, and then going into 27 and 28. Oops, let me just get to there we go. There's the slideshow. Okay. So, as I said, Alex Wilson, broker owner of REMAX Wealth Builder Real Estate, also an active investor like some of you are. I've built a $50 million investment real estate portfolio. I've been selling real estate for over 17 years. In 2022, I was recognized as the number one real estate REMAX agent in Canada for closed transactions. And in 2024, I was number two. As an individual, I've been inducted in the REMAX Hall of Fame, received the Lifetime Achievement Award at 35, Circle Legend Award at 40, also have the Pinnacle Award. But what resonates most with people is that I've turned a deposit of $39,000 into a $15 million real estate portfolio. And I'm going to go into that to start with because it's really important when you're looking at the market today and where it's going, is that real estate is a long-term game. And the condo market's true comeback story is now pushed to 2028. So originally I thought we would have a rebound in 2026 as the ingredients for that were in play. Lower interest rates, slowing completions in 2026. But due to the financial insecurities or financial uncertainty created in the market, that got pushed back due to tariffs. So when we look at pricing overall in the market, pricing is down 35% for Toronto condos from its peak. And the peak was in February 2022. And in some cases, prices are down 25% from pre-COVID, January 2020. 25% down from January 2020. And that is relevant. I see we're at the bottom right now. Well, circling around the bottom of the market right now, but that does create some future opportunity, which there is some foretelling in the market, which we'll get into. But for the past 15 years, my message has been consistent to people. So yes, we saw market down 35% pricing from 2022, down 25% from January 2020. But real estate is a long game. Anyone that's been on my webinars before, I begin every webinar by showing the value of my real estate portfolio today, mortgages included, and then project what that portfolio is going to look like in 30 years from now with all the mortgages paid off by tenants. Yes, if you look at specifically today, if you invested in something in 2020 or in 2022 or even before that and looking at the values and how far they've gone down, things don't look great. But when you look at it over the longer term, things look a lot better. So today my portfolio consists of 15 condos, a triplex, an office building, and an apartment building with a total value of approximately $15 million. As I said, all carrying mortgages. But over 30 years, at a modest 3% annual compounded growth rate, that portfolio is projected to be worth roughly $37 million. Completely mortgage-free at this point, with the debt paid down by tenants over time. So we talked about things being down 25%, things being down 35%. Does that really matter? It doesn't matter, because I know long-term, at the end of the day, in 30 years, I will have a $37 million mortgage-free portfolio for my retirement. Looking at things long-term smooths out the peaks and valleys. That's how you have to look at real estate. I had a conversation with someone this week. They're like, "Oh, I've lost so much money in my condo." I'm like, "You haven't lost any money in your condo because you haven't sold your condo. You only lose money when you sell. So if you don't sell, you don't lose any money." Here's the portfolio. Over 15 years, over 30 years, this will be paid off. So $15 million today, all with mortgages. All those properties have mortgages, and that's the value of leverage. All these properties have mortgages, but the tenants will pay off these mortgages over time, and and the portfolio will be mortgage free in 30 years and be worth $37 million at a compounded annual growth rate of 3%. So short term, here's my outlook. So continued pressure in early 2026. So for the first half of 2026, we're going to see downward pressure continuing on prices, resulting in a 5% decline during this first half. But there are bright spots. So why that decline? Well, we're still dealing with elevated levels of inventory on the market, and it's going to take time to get through those inventories. But with the bright spots, that's where we're going to have stabilization. So what bright spots do we see? Well, there's several structural shifts that are forming that will bring the stability in the second half. So the first one is return to office mandates. 2026 companies will be actively enforcing return to office mandates, probably impacting some of you on this call today, requiring employees to be in the office 3 to 5 times per week. This is happening. There was people talked about in 2025. It's happening in 2026, and it's being enforced in 2026. Have you been on the highway on Wednesdays? It is jammed on Wednesdays. And we're going to continue to see things get worse and worse from a commute perspective as more and more people shift into the back to office mandates being enforced by companies and corporations. And are we seeing impacts of that in the market? Absolutely. And this is where we're going to get into some of the foreshadowing what's going to be happening on the residential side. Toronto is on fire for office leasing, seeing a surge in demand because corporations are bringing their employees back to office. Downtown Toronto experienced its busiest 3 months of office leasing in 20 years. Office market is on fire. Now, and we'll put an asterisk beside it, doesn't mean the pricing is on fire. It means the demand has increased significantly. And AAA office space and financial districts now at a vacancy rate below 3.5%. That AAA office space in the financial district, the banks, government, financial corporations are eating all that office space up. Oxford Properties sees major banks alone could increase office leasing up to 1.5 million square feet in 2026. All the banks are requiring their employees to come back 4 to 5 times per week. And banks and government represent 25% of Toronto's office leasing market. And both are expanding their footprints. They're bringing more people back into the downtown core. And what does that mean? They need more places to live. And it's not just the banks and government. The tech sector is in expansion mode as well, and it's accelerating. We've seen now tech take up 15% of all office space leased in Toronto. And we're seeing the big names come in. These are recent signings of office leasing space expansions in fourth quarter 2025. NVIDIA, I'm sure some of you recognize that name, they just took 136,000 square feet of Portland Commons, and Portland Commons is now fully leased up. This was an office building built on spec. What spec means in the office space is that this building was built with no tenants in place. It was completed in early 2025. You couldn't get anyone to lease office space in the building. People wouldn't even go see it. They wouldn't even go see it. It's located at King and Portland, hence Portland Commons, between Bathurst and Spadina. Office tenants would not even go look at it. They want a financial core. Well, financial core has all been taken up. Vacancy rate below 3.5%. Portland Commons now office space fully leased out. NVIDIA taking it over. Same thing as the Well, which is at Front and Spadina. Shopify had its office space up first on the sublease market. You couldn't get anyone to go look at it. Like Front and Spadina, too far. No one's going to go there. Financial district all got leased up. Boom. Well, fully leased up now. Lyft has expanded its presence 90,000 square feet at First Canadian Place. Robinhood, 60,000 square feet at 25 York. And even WeWork is expanding its office space due to demand. Took another 67,000 square feet at TD and another 16.5 at One University. And why that's relevant. WeWork caters to corporations, especially tech companies, that are prospecting the Toronto market for future office space. They're not quite ready to make a full-term commitment in Toronto, so they're renting the temporary office space from these corporations that manage the short-term office leasing space. Now, for example, I had this recently. I was on a call with DocuSign. If you're not familiar with DocuSign, they're the leading e-signature platform in the industry, e-signatures. They have 30 employees currently working out of the WeWork space. And as they expand their footprint, they're going to be looking for more permanent space in the future. But right now, they're using WeWork as their temporary solution until they're ready to take that next step to have a permanent footprint. That is what you're seeing. So if we're seeing, again, this is foreshadowing. If we're foreshadowing, we look at, okay, if temporary office leasing spaces, short-term leasing spaces, co-work leasing space, if that demand is increasing, then that means there's more companies that are coming to Toronto. And then in that case, in the future, you're going to have more companies looking at setting up permanent shops here once they have their workforce set. Now, why would companies want to expand their footprint in Canada? Well, let's look at it. Office leasing agents are also reporting increase in interest from US-based technology companies to expand in Toronto. We're the third largest technology employment market in Canada, driven by a favorable exchange rate and operational cost savings, access to our highly educated workforce. We have one of the largest educated workforces and most diverse workforces in the world, and it's a geopolitical hedge. You can be a US technology company and serve your global markets from Canada rather than the US. So when you have the political environment that you have in the US right now, you have companies that are expanding their footprint in Canada to do their operations out of Canada versus out of the US, because you're dealing with a tariff-free industry when you're in the technology space. So this is making Toronto in Canada a very attractive space for companies to expand their footprint. There's a cost savings. You need the talent base, and we have the talent base from a workforce perspective. And then from a offering perspective, you have an offering that helps hedge against any political issues. And this, as I was saying earlier, foreshadows the residential leasing trend. Because when you have young professionals that are going to be, because you have more jobs, you're taking all this office space, that means there's more people that are going to be working downtown. And if you have more people working downtown, what do you need? Well, you need more properties for those people working downtown to live in. Not just the young professionals, but also the senior professionals. They're going to be acquiring pied-à-terre properties rather than commuting 2 to 3 hours daily. This shift will drive increased leasing activity through 2026 as many renters test downtown living before transitioning to ownership in 2027, which I'm going to get into the reasons why they're going to transition to ownership in 2027. I'm going to show you the math. But we're going to see the stabilization come into play in the second half, because in the first half, this is when people are starting to come back to the office. So I'm going to be living at home. Then they realize this commute is absolutely terrible. Oh my God, I can't spend all my time doing this. I'm going to move out of my parents' house and I'm going to move downtown, because from a lifestyle perspective, I don't want to be on the road all the time. I want to be close to work. I want to get my time back. So you're going to have a migration of individuals that live at their parents' house and move back downtown. And then the pied-à-terre example, executives that may have moved farther out going, man, my office is making me go back. I don't want to do this commute. I need to stay downtown a few days a week because there's no way I'm doing this commute all the time. So we're going to see that transition happen in the second half of 2026. And that's going to bring stabilization to rental rates, and you're going to see an increase in rental rates as well due to the increased demand. Speaking of increased demand and commutes, there was a survey done that showed that 250,000 households change addresses between early 2024 and early 2025, with more than half of those households who moved to another region left the GTA entirely. When those households relocated to communities far outside the city limits, a shift is going to be colliding with new back to return to office mandates. And that's going to increase commute times, and people aren't going to want to do those commutes, and they may like their life in their new area, and that's where they may get second properties in the downtown core or relocate downtown altogether. And when we talk about commute times, Toronto has the longest commute time in the country at just under 35 minutes. And that's up 1.6 minutes from a year earlier and well beyond the average. And as these back to office mandates become more enforced and more people on the roads, those commute times are going to continue to trickle up. And that's what they're seeing in the Statistics Canada data. So that's the demand side. The demand side, demand will go up for downtown Toronto condos. Well, what's bright spot number 2? Well, supply at that same time as demand is going up, supply is going down. So what happened in the condo market most recently coming into 2023, 2024, 2025? Demand had went down for downtown living because you had COVID and you had people working from home. If I had to work from home, I don't want to be living in a small condo downtown. I want more space. I want to get out of the city. So my demand went down. At the same time, supply went up. At that, you had a record level number of completions for new projects. So simple economics, as demand goes down and supply goes up, prices went down. You had rents go down, and you had the demand for those properties at the same time go down. On top of that, you also had an instance where you had the fastest rate of increased interest rates ever, even faster than the 80s. Interest rates climbed at their fastest rate ever. So you also had downward pressure in regards to the valuations on the properties because the expenses went up for investors at that time. So you had a pullback from investors as well. So you had a double whammy from a demand perspective as investors pulled away from the market, and you also had individuals looking to live downtown pull away from the market because they could work from home, and then you had supply going up because you had the record number of completions. It was a perfect storm in the environment. Now, demand is going up because you have back to office mandates, all those people work from home. Oh, well, guess what? You have to go into the office now. So demand is going up. And at the same time, you had interest rates go down. And from interest rates going down, we are now just 50 basis points away from where interest rates were in January 2020. So we're back to the environment to where we were fairly close pre-COVID. So what's happening now? So demand's going up and the supply is going down. Well, why is supply going down? Well, we haven't really had we haven't had pre-construction sales for the past few years. Without pre-construction sales, you can't build new condo projects. And because no condo projects have broken ground in the last few years, our 10-year moving average for condo completions we're below that now. So in 2024, we were significantly above. In 2025, same thing. But the surge in supply was a major factor behind the declining rents. But what happens in 2026 is now that 10-year moving average is going down. We're just going to hit maybe about 17,500, below about 1,000 units below the 10-year moving average for units, supply going down. Then after that, we drop another 10,000 to 7,500 units in 2027. And then after that, we go down to 5,000 units in 2028. The supply of new units coming on the market is dropping off a cliff. So as the supply goes down and demand goes up, what happens? Well, we'll develop price stability and prices will eventually start going back up again. And this is where you see it here. So I love this graph. This is by the folks at Talk Condo, Emma and Roy Bendari, they put together this graph. So you're seeing the completions of these projects. Now, the key thing is, though, that red, those projects haven't started construction. They're not starting construction. They're in the process of being canceled if they're not already canceled. So the blue is actually what you're going to be getting for completions. And as you see, when you get to that 2028 mark in this graph, we're at 5,000, and then nothing in 2029, nothing in 2030. What happens in 2028? Well, here's the whole timeline for what's going to be happening over the next 3 years. As I said earlier, we're just 50 basis points away above the 2019 interest rate levels before COVID. And then, and if you recall, we were going into an interest rate increasing environment. Interest rates were expected to increase in 2020. The economy was strong going into 2020. The Bank of Canada was looking at increasing interest rates. Now, did that happen? No, because we had a pandemic happen, and rates were cut. But we're on the road to higher interest rates in 2020. So we're right in and around where we would have been in 2020 from an interest rate perspective. Rents are expected to begin increasing in the second half of 2026 due to the back to office mandates being enforced. Demand rises due to that enforcement, and new condo completions are falling below the 10-year moving average. So I'm expecting stabilization in the second half. So again, we're not seeing any price increases yet, but we're going to see rental stabilization, and we're going to see price stabilization because we're in and around the bottom after the first half. Then getting into 2027, we're going to see continued rental growth as new supply drops below 7,500 units. And after 1 year into the office mandates, you're going to have renters begin reassessing the cost of renting versus owning. And you're going to see increased condo sales and modest price appreciation because the people renting these units after living in them in the year going, hey, why am I renting? Why am I putting money in Alex's pocket? Why am I putting money in the landlord's pocket? I could be putting money in my pocket, and I'm going to buy the property that I lived in. And that's where you'll start to see very modest price appreciation because we do have supply we have to get through before we see that modest price appreciation. But then in 2028, when new condo supply effectively stops for 5 to 7 years, why 5 to 7 years? You need condo pre-sales in order to build these buildings. So I'm going to give you a history lesson. Back in the 80s, you didn't have to do pre-sales. There was no pre-sales of condos. Banks would just loan and you build a building. Well, you had a condo crash and the banks were left holding the bag and the loans on these. And like, well, we're not going through that again. So now we require pre-sales before we finance the construction of the building. And that's the market that we're in today. In order to build a building, you have to pre-sell the building to individuals. Well, there is no individuals that are buying these buildings right now. Only exception to the market would be larger end user units. Those individuals are buying units, and those are selling for a very high price per square foot. And users will buy that are downsizing. Now, there's no pre-sales for condos. Since there's no pre-sales for condos, there are no new condos being built. And it takes 5 to 7 years for one of these buildings to be built from sales to completion. Therefore, since there's been no new condos sold in the last few years and none forecasted in 2026 or 2027, you're not looking for any new condo supply for 5 to 7 years from 2028. No new condo supply. None. Zero. Done. None. But demand continues to rise due to population growth, and the next condo price cycle begins. That's what we're looking at over the next few years, and when we project out forward. By the end of 2027, limited new development creates the conditions for the next sustained condo price increase. So again, we're going to see continued pullback. A big first half of this year, probably another 5% reduction. Stabilization into the second half, modest price growth in 2027. End of 2027, 2028, that's when you see pricing start to jump. So why would there be an upswing? Well, the math works again to be a Toronto condo investor and essentially an end user of the product. And I wanted to walk through now the math on why people would return to the market. So this is a building, a unit that recently sold in Q4 of last year. 2-bedroom, 2-washroom, junior 2-bedroom condo, downtown Toronto. I personally own a unit in this building. It sold for $550,000. And now when we run the math on that, so we purchased the property for $550,000, and when we factor in maintenance fees, property tax, and the mortgage now, because rates have gone down, you can get a mortgage on this property for 3.79%. The monthly cost of that property comes in just under $2,800. Well, the monthly rent on that is around $2,800. So you're actually cash flow positive slightly on this property now. Before you weren't. Now investors, if they're entering the market today, can get cash flow neutral, cash flow positive properties that they can add to their portfolio. And these properties, as we discussed, the demand is going to go up and you're going to see rental price growth on these properties. We're still below the rental rates that we were achieving on these properties in 2019. And because we had to pull back in demand because of COVID, now back to office mandates come back into play, there'll be stronger demand for these properties. At the same time, when supply is effectively hitting, new supply effectively hitting zero, and you can't build anything new for 5 to 7 years. So during that period, if you were to invest in a property, your first year, principal payback alone. This is real estate investing 101. As I showed in the very first slide, my portfolio, I buy real estate assets, a tenant moves into them, over 30 years, the property's paid off. In year one, $8,000 of that mortgage is paid off. Over 5 years, $43,000 of that mortgage is paid off. But what else happens? Well, we factor in 3% compounded annual growth per year. Remember, pricing is down today, 35% from peak, 25% from 2019, 2020, before pre-COVID. Well, in 2019, this condo would have sold for $710,000. And in March 2022, $850,000. If I just factor in a conservative 3% compounded annual growth rate over 5 years, that's $137,000, almost $138,000 in growth. And that would make the value $637,000. That's still 10% lower than the 2019 mark, just to put things in perspective. That is 10 years from, no, more than 10 years. That's 12 years from when this was initially the initial valuation of 2019. 12 years from that mark. And then if we did 5% over that period, that's growth of $201,000. And that's just slightly lower than 2019 value and still 17% lower than the 2022 peak. So you can see the runway for these prices to go up. And now, if you're a savvy first-time buyer or parent, this is the playbook I ran. This is exactly what I did when I was in my 20s. Instead of renting a 1-bedroom downtown condo for $2,200 a month, that's what a 1-bedroom would cost you today. That would cost over 60 months, over 5 years, that would cost you $132,000 in after-tax dollars. And at the end of those 5 years, when you give notice to your landlord, what's your return on investment? $0. Here's $132,000. Thank you for providing me living accommodations. And what's your return on investment? 0. Now, you're the savvy first-time buyer or parent. So instead of renting, you purchase a 2-bedroom condo. The monthly cost in that, as we showed above, just under $2,800 per month. You get your principal payback of $43,000. You get your appreciation of $137,000, of just a 3% compounded annual growth rate over that 5-year period. But then you rent out the second bedroom to a roommate for $1,200 per month. And then if we factor in that difference, we're going to factor in, hey, if I would have rented on my own versus 28, okay, we'll take $582 off of that. So $1,200 less $582, you're still going to get another $37,000 in your pocket from your roommate helping you pay the mortgage on the property. So the end of 5 years, when compared to renting the property on your own, you would have $218,000 gain on the property. And what does that do? What's that $218,000 do? Well, that's your down payment. Like you would have probably $100,000 in the property. So now you have $318,000. Now that's your down payment for your next home, your next stage in life. Or maybe you're keeping that as your long-term retirement plan, but you can use that property to finance or to purchase your next home, your freehold property. Because what's going to happen is the affordability gap between condos and freehold is growing again. So pre-COVID and then during COVID, you saw them coming together. Now it's gone like this. So freeholds, even though prices have went down a little bit, condos have went down significantly more. So the gap between condos and freeholds, I'm not even the camera frame anymore, has grown significantly. And when you see the price growth go like this, you eventually see condos shoot over like this and start increasing significantly in value because that's the only thing people can afford. And I gave the example here. So the average price of a Toronto condo right now is just under $700,000. If you went for the lowest possible down payment possible, you could do a CMHC insured mortgage. So that means the minimum down payment on that is $44,924, which you can use an RRSP home buyers plan, which are up to $60,000 available in that. So you can use tax sheltered funds to buy your first property tax advantageous funds. And if you're buying with someone else, you could double that 60,000. Freehold. Minimum payment, the average payment on that is $116,000, just under $162,000. The minimum down payment on that is 20%. So that means you would need $323,000 to buy that property. If you were just a first-time home buyer, where would you get that $323,000? But if you had bought a condo today, and as I outlined the example, you buy the condo, you have your initial down payment, and then with appreciation and principal payback, you would actually get to that $300,000 mark to buy your first home. But if you didn't, then you wouldn't ever be able to buy your first freehold home. It's me. So this is the formula in order to continue to do the step-up living process. And as the real estate cycle restarts in 2028, rising condo prices will eventually push buyers up the ladder, resulting in outside price growth for freehold homes where supply is fixed or declining due to the absence of new freehold subdivisions in Toronto. There are no new freehold houses being built in Toronto. Sorry, take that back. There are new freehold houses, but there's no new increase in supply. It's actually decreasing because you may have older homes, a block of those knocked down to put a more dense project in. So you have a declining supply of freehold properties and always continuous increasing demand for those as population grows. And how are you going to buy that property? You buy the condo first in a down market, and then you use that to help fund your next purchase. It is something I have done. It's how I started in my 20s and now have the portfolio that I have today. So as the recycle starts, as I said, you're going to have condos, then fund the increase in the freehold homes in Toronto. And guess what happens then? Condo prices go up. More people buying freehold homes in Toronto. Those prices go up. What happens then? People start selling freehold homes in Toronto. They start moving to the other areas, your Oakvilles, your Mississaugas, your Vaughns, your Burlingtons, your Whitbys, your Oshawas, Durham region. That then starts flowing out again. And that's the whole real estate cycle starting over again. And it's not just me saying this. It's great that I'm saying a lot of this, but I want you to go out and do your own research and read what's out there. Sharing the report by Benjamin Tall, chief economist at CIBC. He's always talking about the Toronto real estate market and Canadian real estate market in overall. He has the report, The Housing Market, where we're at. He came out on September 11, 2025. I have a QR code right there. You can go ahead and scan that and read the report on your own. But since the release of that report, the Bank of Canada has cut interest rates twice, this September 17th and October 29th, further strengthening the report's conclusions. The analysis reinforces the expectation that both rents and prices in Greater Toronto will experience meaningful growth in 2028. I encourage you to read that report. If you want me to go deeper into this stuff, if you have more questions, you can book a call for me. There's a link there, remaxwealth.com. Book Alex, QR code as well. Nish, Kyle, Monty, Jeffrey. We're all, any wealth builder agent, we're all well versed in this dialogue. So please reach out to them as well. They will be helping you with any questions that you have when it comes to investing in real estate and what the best thing to do is with your real estate portfolio. We're all real estate investors. We live the life that you live, and we're happy to help you through any decisions you want to make, whether it's selling property, taking advantage of the current market opportunities, buying property, or just maybe how to reposition your current real estate portfolio. We've helped over 1,500 people from across Canada invest in real estate, and we want to continue helping you as well to maximize your wealth and minimize your stress while using real estate as the investment vehicle. So I'm going to open up the floor now to any questions that people may have. There I am right there. Okay.